All right, guys, let's get back at it. Want to just say something just so that you can calm down. We will make up every minute that we missed this morning. So we're going to still get the same time. You're still going to get the same presentation, not cutting anything short. I'm here to deliver. It takes all day and all night. I'm going to make sure you get what you need. All right. So don't get worried. Don't start fretting. I missed this and I missed that. You ain't missed jack. All right. Because I'm going to give it to you. Matter of fact, you're going to get more than what you bargained for. Guaranteed. Because it goes back again to what I told you earlier. If you think education is expensive, try ignorance. And then also it goes back to what I said again about those knows. What you know, what you don't know, and what you don't know, you don't know. So I'm going to tell you, I'm going to give you some nuggets during this workshop. If you haven't gotten anything already, that's going. You would more than already have paid for the workshop. And when I start giving them to you, I guess I might as well tell Dave and them to unplug because you got your money's worth already, regardless of wherever else I go. Because you're gonna learn some things through here that are going to save you some money. Did you know about hiring kids in your business? Did you know that you can hire your kids in your business and actually pay them and reduce your income, reduce your overall income for your business? We're going to talk about that. All right. We're going to talk about that. $12,400 per child. What you think about that? That's going to be worth the price of admission in itself. Did you know that you can form a corporation that you can actually have that corporation that you formed rent your actual home up to 14 days a year? Okay. Example, you form a C corporation. We're going to talk about it later, but I just want you to know because I want you to stay glued to that television or whatever you're looking at because you're going to get it. All right. Did you know that you can rent your home to your business for business meetings and functions? Okay. For up to 14 days a year. Let's just say that was $1,000 each and every time that your business is paying you personally. You just wrote off $12,000 just like that. That's a direct tax savings to you because you don't have to pay money to yourself personally, from yourself personally. So that is a tax-free write-off for you. You paid yourself some money from your business and write it off 100%. And I'm going to show you the IRC, the Internal Revenue Code that supports it. So talk junk on that, because that just saved you a boatload of money in itself. Travel for your business annual meetings. Did you know that you're required to have annual meetings for your business? Did you know that you could take a family trip to Disney World or wherever you're going, and as long as you spend a certain portion of that time dedicated to actual business function, you can write off the trip? When you know, you know. Did you know that you can actually take and put money in your pocket from your rental property and show a zero tax return because you had massive losses that actually made you look and appear on paper like you didn't make any money, and you know you put real money in your pocket? That's what we're going to learn over this weekend. And just me telling you that right now so you can go research it. You already paid for the workshop if you didn't know. So just buckle up, sit back, sit tight. It's coming your way. All right. So what we talked about at the end, we talked about the properties that go to trust. And one of the things I want you to know, guys, is that the secret to success is to own nothing but control everything. That's Nelson Rockefeller. Own nothing but control everything. So you don't, like I said, you don't want your stuff on public record. You want, when people actually are Googling you, land gliding and doing whatever, you want that property to be in a trust because they don't know who owns it. If you're looking at the picture on the slide, it shows a property that's held in trust. Nobody knows who owns it. Okay, you don't know who the heck that is. Who is the Greater Cameron Park, whatever trust? You don't know who the heck it is. You don't know who has something to do with it. And that's where you want to be. That's how we protect our assets, guys. All right. So let's talk about that in itself. We said we were going to come back and pick up talking about the different entities. All right. And so let's talk about protecting your assets, estate planning with trust. All right. So in protecting your assets, all right, this is what's going on. There's 3 sides to an asset protection plan, guys, and all of these 3 parts work together. So basically you have a legal side, which is based mainly on state law. You have a tax side, which is based on current tax law provisions. And then you have the IRS side, which is basically based on IRS auditing and audit statistics. You want to make sure, guys, that you have all of these things working for you as a part of your tax plan, and as a part of your estate plan. All of this stuff ties in for the good, guys. Oftentimes, we got to make sure that we have the right professionals on our team that are working together collectively and coherently so that you make sure you have the best structure for yourself, okay? Your attorney might be telling you to do one thing and your CPA saying something else, and vice versa. You need to get them working on the same page, all right? Because again, we want to make sure, number one, we protect ourselves from lawsuits. As you see illustrated, it said, I didn't know the extent of my injuries until I was examined by my lawyer, okay? So you want to make sure that's not you. You definitely don't want to have that coming your way. So let's talk about entity structure. Entity structure, guys, is what you're doing as a part of your business formation, all right? You want your alter ego, all right? Your alter ego is that business that you actually perform. That's part of protecting your assets, guys. So you got 2 things going on. You have your social security number, and then you actually have your business, EIN, or employee identification number. That's what you have to have, and you want it to be done in a manner that gives you the highest and best tax plans, okay? Meaning that you minimize your tax consequences, okay? And you also want to make sure you get the best protection in case you have some type of lawsuit or some type of negative situation come your way. All right, so let's talk about the entity types. The entity types, we have sole proprietor partnerships, all right, which are general partners, limited partners, limited liability partners, corporations, S Corp, C Corp, all right, and then limited liability company. All right, let's talk about sole proprietors. Sole proprietors are the absolute worst entity that you can be in. That's where you're basically operating personally. I want you guys to understand that, and I'm going to explain and tell you why. Sole proprietor is not where you want to be. You can be a sole proprietor because you started up a business just on a handshake with a person. That's still, well, that wouldn't be sole proprietor, but that would be a partnership where you're still at risk just the same as a sole proprietor. But sole proprietor, you decide to start a business, you don't form a company, you're just operating personally. Everything you have is at risk when you're a sole proprietor. Everything. I want you to understand that. So if you're a person that has a couple of rental properties, you don't know it, but you're in business. And if you get sued, you're going to get sued personally. You don't want to be there. If you're out here doing real estate right now, okay, and you haven't formed your business yet, then you're operating personally. And you can get killed with this stuff. So I want to make sure that you understand that and you take measures to get all this stuff corrected going over the next few weeks. All right. When you're a sole proprietor, you use a federal Form 1040. Schedule C. Schedule C is the most frequently audited tax form that there is. Listen to what I'm saying. That's the schedule of your business expenses, guys. All right. That's your business profit and loss. Schedule C. You don't want to be there. This is why you don't want to be there, because they're the most audited form that there is. And the reason why they're the most audited form there is because every Joe that decides they want to have a business, let's say, for instance, you start a landscaping business, and most of what you do, you're taking cash payments because you don't want Uncle Sam to know you're making any money, right? So you basically do a tax return where you're reporting maybe $10,000 worth or $5,000 worth of income, but then you're writing off $30,000 of maintenance, gas, lawnmower expenses and repairs, and the whole 9 yards, thinking you're going to get a tax return. The IRS knows that you're going to be there, okay? They know that if I go look in this pile of stuff, I'm going to find somebody that we're going to be able to make some money off of, and we're going to do some collecting. So you don't want to be on that Schedule C. All the expenses you deduct on Schedule C or on your Form 1040, you have to prove them, all right? Profit is taxed as ordinary income, which is the highest tax rate. If you're going to use your home for an office, you have to prove it, all right? When you're a sole proprietor, you have a bullseye not only on your front, but you have one on your back as well, all right? There's also a higher risk of having your corporate veil pierced. And the reason I'm going to say corporate veil pierced, guys, is because I want you to listen to me closely right now. If you even have an LLC, that's a single member LLC, then you're considered a sole proprietor for tax purposes, because a single member LLC is considered a disregarded entity. So you still file your taxes on Schedule C. That was worth the price of admission right there. If I cut it off right now, you should be done. You got your money's worth. Because I'm telling you right now, if you have an LLC and you're walking around thinking you're good, well, you're not good. Because a single member LLC, for all practical purposes, I'm gonna tell you, the way we're using it, it would just be trash for you, okay? Because you have a higher frequency chance of audit, okay? And you're actually exposed, because there's been many case rulings that basically allowed individuals with single member LLCs to actually have their corporation veil pierced, because it's hard to sit there. Although legally it's supposed to be a separate entity from you, if you're sitting in the court talking about, well, Your Honor, it really wasn't me, it was my company. Well, who's in your company? Just me. You look like a fool. So what I'm trying to tell you is okay, there's been opportunities at many courts, particularly in many states, California namely for one, that would definitely just come and pierce your corporate veil, and so then you're standing there naked, okay? So you don't want to be a sole proprietor. You do not want to be in that space, because when you are a sole proprietor, you're operating personally, and everything you own is at risk, to include the drawers inside your dresser drawer. And I do actually mean the drawers. So you look in there, you see what arrow is, that stuff is at risk with everything else you got. So you don't want to be there. Cars at risk, your personal residence at risk. Guys, you do not want to be out here doing real estate and something that you did in real estate caused you liability to the extent that you lost your personal residence, your car, or maybe even your wardrobe, okay? So we're going to talk about how you remedy that, all right? Partnerships. Partnerships are just as bad, okay? Because partnerships, guys, generally, partnerships is where you get a couple individuals maybe or more, and you guys get together on a handshake and say, hey man, you got a little bit of money and I got a little bit of money. Why don't we go out here and let's just go buy a couple of these houses down here. And now when not only are you're personally at risk on every one of those transactions. Matter of fact, you're also at risk for what your partner does. Your partner goes and does something crazy, and now you're in the middle of this mess, all right? Partnerships are easy to form. They're hard to break up. Most of the time, they're hard to break up because we didn't do what we need to do when we made the partnership. We didn't discuss all of those D's, okay, before we got in and had a situation or a problem. Those D's, meaning somebody got disgusted. Maybe we had a divorce. Maybe we were going to dissolve. Maybe we were disillusioned. Maybe we're disenchanted. Okay, maybe there's death. We didn't discuss those D's up front because we were happy and smiling. And that's the time when you actually do your partnership agreement and make sure you're all on the same page. While we're happy up front preparing this agreement, because once everything goes south, then all hell just broke loose, okay? And now we can't do anything but argue in court, okay? So you don't want to be in a partnership. All right. Next one, corporations. All right. Corporations provide maximum liability protection. You must keep accurate records, must conduct official meetings. Okay. Tax rate is 15%. That's wrong on that slide. So I'll make the correction. Tax rate, the effective tax rate for a C corporation is 21%, period. And I'm going to talk about that on the next slide. So that changed with the Tax Cuts and Jobs Act. So just don't worry about that one. I'm telling you, the tax rate is 21%, period, flat tax. Don't worry about the first $50,000. Tax rate is 21%, period. S corporation, the tax rate is your personal tax rate, okay? So what, because an S corporation is a flow-through entity. Everything that goes in flows down to you. A C corporation is a standalone entity. Everything that goes in gets distributed either by salary or distributions to the owners, okay? That's the difference, guys. The C corporation can actually retain income, all right? So again, we want to make sure we understand each and every entity and how it actually best suits us if we desire to actually use that entity in our business. For example, I've ran across individuals that would, if you come and you meet me anywhere, anytime, usually if we start talking, I'll start asking you, you tell me you're in business and, everybody wants to be impressive all the time. I start asking you questions. So how's your business set up? What do you do with this? How you do that? So how do you do your taxes? How are you filing this? And people start wanting to just tell me anything because you want to sound impressive. As soon as you open your mouth, I know you was full of junk to begin with. So what I'm trying to tell you is that you want to make sure, guys, that you form something that suits your needs. One size doesn't fit all. And so going back to what I was going to say, I've had individuals come to me and they tell me, when I ask them those questions, so how are you set up? Well, got me a little C corporation, I formed a C corporation because, that's what I got my stuff in. I'm like, you formed a C corporation, well, what are you doing? Well, I got me like 5 rental properties and, I'm still doing business. I got 5 rental properties. I said, so why did you form a C corporation? Well, I formed a C corporation because, I don't know. I mean, that's what I thought. I went on the website and I said, man, I'm gonna form me a little corporation, because everybody was telling me I need to get me a company, right? And so now you formed a C corporation, right? Because you wanted to have the title of Randall Properties, Inc., because Inc. sounded good to you. That was the title you wanted, okay? But when you formed a C corporation with rental properties, let me tell you right now, you was just a new fool, straight up. You were a new fool because now you formed the company that you're collecting rents. All of your rents are being paid to your company. It's taxed at 21% in the company. And then when you go to pay yourself, you're going to be paying taxes again. So now you got double taxes on the money. Okay? That's why it's important to know exactly what business you are actually doing so that you can know what entity works for you. For you people out there that say I'm in the wholesaling business. Guys, let me tell you something. You're a darn real estate investor. Wholesaling is just an exit strategy to real estate investing. Y'all got that? You're a real estate investor. Wholesaling is just one exit strategy to real estate investing. And we're going to talk about what best suits you as a wholesaler. All right? Like I said, S corporation is the tax rate, is your personal tax rate. It requires effort to add or remove members in an S corporation, and you might want to consider it when you have 6 or more homes, all right? It's definitely good for flippers. I will tell you, we'll talk about as we go along what best suits you based on certain circumstances, and we can talk about that. Again, you may want to look at your situation based on what I'm saying and still talk to your CPA or tax strategist to help you determine where you need to be, because if certain employment situations may mean you may do something, be a little twist to something other than what you might hear from me. But for the most part, I'm gonna let you know you're probably gonna be like right in 95, 99%, accuracy on what you need to do or where you need to be. All right. Next, we're gonna talk about the actual C corporation. All right. So they're treated as a separate taxable entity, which I explained earlier. C corporation, when you put something in it, all the profit goes in it. It stays there. It's in that entity, sole and entirely. Okay. All right. The earnings are subject to the corporate level tax rate. C corporation tax rate starts at 21%, and right now it's a flat 21%. There's no passive activity loss limitations. You're going to learn what passive activity loss limitations are as we go a little bit further, unless you're a personal service company or a closely held corporation. All right, and we're going to talk about that because some of you are going to want to set some of that stuff up, and I'm going to explain that as we go along. There's limited liability afforded to the owners of a corporation. All right, there's limited liability afforded. All right, next one, S corporation. S corporations, no taxes paid at the S corporation level. What I said earlier, guys, S corporation is a flow-through entity. Everything that goes into the S corporation flows down to the owners of the S corporation. All right, in according to how they get their distributions. Incomes, gains, losses, deductions, and credits pass through to the shareholders. Only one level of tax, okay? And that's actually going to be your personal tax rate. We're going to talk about that. S distributions are subject to self-employment tax as well. So we're going to definitely talk about how the self-employment taxes come into play, particularly if you're wholesaling or flipping properties. Okay, passive activity loss limitations apply. The corporation can't have more than 75 shareholders in it. All right, and they enjoy the same limited liability under state law as the C corporation. Okay, all right, now these are tax filing entities, guys. This is just a tax status more so than anything, okay? All right, so I'm gonna talk about the S corporation for a second, how it may be beneficial to you. Once you listen closely, very closely, all right? Because many of you know this man right here. This is John Edwards, all right? John Edwards was a U.S. Senator here in our state of North Carolina. John Edwards was a highly paid trial attorney, okay? Highly paid trial attorney. Back in 1995, 1998, and many of you know this as well, that John Edwards ran for president several years ago, and then he had some problems. We won't talk about that. But John Edwards, back between the years 1995 to 1998, John Edwards had an S corporation set up. He paid himself an aggregate salary, so he paid himself on average $1,260,000 a year from his business. However, over that 3-year period, John Edwards made $25.5 million. So out of $25.5 million, he was making better than $8 million a year. He said that he paid himself a reasonable salary out of that money. I want you to understand, John Edwards got all the money, guys, but he only paid himself a small percentage of that to save on taxes. He saved about $600,000 in Medicare taxes by what he did, okay? Because what I want you to understand, and we're going to talk about this in a second, John Edwards knew that basically, guys, that he was going to avoid paying a bunch of taxes on his money by virtue of how he paid himself. So I want you to listen to this, particularly for you guys that are wholesaling, because this is probably the entity you want to have. You want to have an S corporation, but better still, most of us guys, most corporations, C and S corporations, require so many different formalities, that things that you have to do, and just be honest, most of us aren't going to do that stuff. We're not going to have all these meetings. We're not going to do all the things that the corporation requires. So you don't need to be there, because if something happens and you have an incident or some type of situation where you have liability and exposure, then they're going to ask you to prove yourself, okay? And if you don't have all the documents, they're going to pierce your corporate veil. So the best thing to do is to have an LLC that's taxed as an S corporation or C corporation, because we haven't gotten to the LLCs yet, but they have their hybrid vehicles or their hybrid entities. You can do a lot of things with them, okay? And so what I mean by that, guys, is that they have very few formalities as well. There's some stuff you have to do, but not as much as a regular corporation. So therefore, you can set up an LLC much easier, have it taxed as an S corporation, and get all of the benefits that an S corporation gets. So going back to this story, John Edwards, the IRS challenged John Edwards on him paying himself too small of a salary. Okay, they say he didn't pay himself enough money. All right, John Edwards, that's him standing outside the courthouse because he won his case. All right, they said that the IRS said that salary wasn't fair and just because he only paid himself a fraction of the money. So what John Edwards did was he went out and he did a survey and found out what the average highly paid trial attorney in Raleigh, North Carolina made, or in Wake County, North Carolina made. And he found that to be about $1 million a year. So he paid himself $1,260,000. I want you to understand this, and I'm going to explain it to you in better detail later, is that when you have an S corporation, the money is paid in two different ways, guys. You got money that you pay yourself as salary, and then you have money that you pay yourself as distribution. The money that you pay yourself as salary is taxed at your individual tax rate. All right? The part that you pay yourself as the money that you pay yourself as salary is taxed at your individual tax rate, and it also you have self-employment tax on top of that. So whatever your individual tax rate is, let's just say you're the 24% tax bracket, you're going to pay 24%, and then you're going to pay 15.3% tax on top of that as self-employment tax. All right? So now you see how much money, you see how much you're paying in taxes. The part that you pay yourself as distributions is only taxed at your tax rate and doesn't have to pay self-employment tax. So you can see where I'm going, why an individual would want to think that it's more beneficial just to pay myself distributions because I don't have to pay self-employment tax. And we're going to talk about how you work through all this here shortly. All right? I want you to understand something, guys. When you're doing all this stuff, Uncle Sam is a not so silent partner in your business. He's smiling just as much as you smiling. And most of us out there, we don't even know he's smiling because some of us haven't been in business long enough to actually have to pay a tax. All right. And I'm telling you, you don't want to you don't want to send in your stuff to your tax preparer. Okay. And then they're calling you up on the 13th or 14th of April and tell you, hey, I got your taxes done over here. And everything's done up. We're gonna send them in, but you need to swing by and bring a check for about $20,000. Okay, so that's not where you want to be. All right, so we're gonna talk about what we do to not be in that situation. The other thing is, again, talking about those no's. We have to know, guys, if you're in business, it's important that we know our tax brackets. It's important that we know how we get basically taxed. All right, so according to the new Tax Cuts and Jobs Act that came out several years ago, this shows you the tax brackets for 2020. So if you look at the tax brackets, you know where you're at. If you're single, you see where you fit in. If you're single and you made $40,000 to $85,525, then all right, that you're in the 22% tax bracket. If you made $85,526 to $163,300, you're in the 24% tax bracket, on and so forth. I want y'all to understand something right here because most of us, see, this is why I'm talking about those no's. This is why we have to educate ourselves. All right? I want you to see something. If you're looking at that chart still, and you can still look at me and look at that chart, but what I want you to understand is this. I told you that the flat rate tax on a C corporation was 21%. 21% flat rate tax. Now, if you're single and you make $163,301 to $207,350, your tax is 32%. Did y'all hear what I just said? Your tax is 32% on $207,350 max in that situation. If you're married filing jointly, same thing. $326,601 to $414,700, you're in the 32% tax bracket. What's your point, Tony? My point is this. My point is that you're paying 32% tax on that amount of money. Microsoft, Amazon, Apple, they're making billions of dollars and pay a flat 21%. Okay? That's why you have, and they know how to work the system. That's why you can have our president, we're not getting into politics, but several months, well, last year, New York Times said that Donald Trump spent a decade in the red, showing over $1 billion worth of losses, okay? And in some years, averaging almost, $900-something million worth of losses over time, or averaging more than $250 million worth of losses every year, basically. Let me say that. Averaging better than $250 million every year for almost a decade. Did y'all hear me? Averaging losses, but yet and still say, I'm a billionaire, flying around in aircraft, name on buildings, okay? And we can get mad at some of this stuff, guys. We can get mad and get upset, but the point is that a lot of this stuff is not that there was something frivolous going on. They know the rules. They know how to work the system. And that's why you have to learn how to work the system. You have to learn the rules. Because again, what I said earlier, you don't know what you don't know. And some of you guys have seen these slides before, but I'm gonna show them to you again. Because if you're a wholesaler, going back to if you're wholesaling and you went out and you're signing or you flipped the deal and you're sitting there celebrating, right? Oh man, I'm posting checks on Facebook and Instagram, letting everybody know I'm rocking and rolling, okay? Well, you were posting checks, okay? And maybe you was flipping deals, maybe you did some seller finance, you wholesale something, $30,000 on one, almost $19,000 on another. Oh man, I'm rocking and rolling, right? Now you just like me and my wife, what? You chilling on vacation, right? You chilling, having you a good time on vacation, everything is good. All of a sudden, you find out from your CPA or whatever that IRS got a bill for you. Uncle Sam wants his share of the profits, right? Uncle Sam wants his piece of the action, guys. You didn't even know you was in partnership with Uncle Sam. Uncle Sam didn't put out not one bandit sign. Uncle Sam didn't cold call nobody. Uncle Sam didn't do any driving for dollars. Uncle Sam ain't scheduled and have a whole team full of VAs that you got to pay. But Uncle Sam wants his part of your partnership. And you sitting there was chilling, and now you see you got a tax bill of $15,789 that your CPA wants you to bring to the office. CPA says, hey man, I need you to come on in. And you looking like this guy right here. What, really? All right, and now what? You got just what you see on the screen. You writing a check to the IRS for what? All my money. And then you talking about in the memo, what? For some John Brown taxes, but y'all didn't say nothing about no John Brown. You know what you said. So you don't want to be in that situation. So you want to make sure you set up taxes appropriately so that you can do what you need to do to minimize. You want to make sure you set up a tax plan appropriately so you can minimize your tax consequences. So let's look at an example here. All right, you're a wholesaler. You go out and contract a property that the after repair value is $100,000. Let's say it don't need no repairs or whatever. After repair value is $100,000 or fair market value is $100,000. You contract that property for $60,000. You turn around and sell that property and do an assignment on it for $68,000. You made $68,000 as your wholesale fee. All right. Let's look at that. So you made $68,000 on that wholesale fee. What does that look like? What it looks like is this. All right, you got federal income taxes on that money. If you were in a 22% tax bracket, that's $1,760. You got FICA, which is your self-employment taxes, at 15.3% on top of that. And then you have state and local taxes. If you have state and local taxes in your area, here in North Carolina, our state and local taxes is 5.35%. So effectively, with all those taxes, you're paying 42.65% taxes on that $8,000 that you made. That means that Uncle Sam is getting $3,412 out of your $8,000, and you netted $4,588. See, guys, what you didn't realize is, see my man hanging upside down, that was a shakedown going on right there. And you didn't even know you were a part of it because you weren't formed properly, number one. And that's why that's why you're like surprised. I didn't know it worked like this. Well, surprise. I just told you it worked like that. So now you know. So now that you know, you can go fix it. All right, so let's just say you did that 10 times, same situation. What does that look like? Y'all can see the numbers, all right? Made $80,000 if you're still in that 22% tax bracket. $17,600 goes to federal taxes. $12,240 goes to self-employment taxes. State tax, $44,280. Again, your effective tax rate is 42.65%. Total taxes paid, $34,120. So you made $80,000 and you almost gave half of it to Uncle Sam. See, you're hanging upside down and money's dripping and falling out your pocket. All right, so let's break that down if you actually had an S corporation. If you actually had an S corporation and you did the same thing, then this is what it would look like. Out of that $80,000, you decided that I'm going to pay myself, right? I'm going to set myself up on payroll. I'm going to pay myself $20,000. That's my salary for the year, okay? That $20,000 is going to be taxed at 22%. I'm going to pay the remaining balance in dividends, all right? So you're going to pay self-employment tax on that $20,000, $3,060, right? You got $4,400 in federal tax. Pay yourself dividends, and those dividends you're going to pay 22% tax on the dividends. That's $13,200. State and local taxes, $4,280. So you're going to pay $24,940 in that situation right there in taxes, minus any business expenses you might have had. I want y'all to realize that because I'm going to show you right here what that looks like. By doing it that way, you actually saved almost $10,000. You hear what I just said? Doing it the way that most of you are doing it right now, you paid $10,000 more in taxes because you didn't know you need to be set up as an LLC. Now, y'all know I talk about church. Every time I say something like that, y'all just find you an offering plate. They open up. Y'all find an offering plate in your house somewhere because I just saved you $10,000 in that situation. So just go ahead and just put a little something on the envelope and send it this way. Because you just got a nugget right there. So for those of you out there that's wholesaling, all right, there you go. You need to know how you need to be structured. All right. Now, let's look at I want to talk real quick, and I want to show you basically if you decide that you want to keep something, because that's what we want to do. We want to aspire to have something on our board, guys. We want to aspire to own something. So let's just say in that same situation, we bought that house that was worth $100,000. We placed it under contract for $65,000. From the point in time, instantly, once we contracted that house, we have $35,000 to our net worth. We was walking around talking about we broke. Now we got $35,000 worth of net worth. If that house appreciates over time, 4% appreciation rate, then that home in 5 years would be worth $126,531. I'm talking about now I'm building equity. I got something tangible. I got an asset, right? So basically, if you look at that, as an investor, you have $61,531.90 in equity between rental income and tax deductions that you're going to get by virtue of you owning that house. Okay, so I want you to start thinking a little bit differently. This is a part of asset protection, tax planning. Okay, remember, it's not what you make, it's what you keep. You can make a whole boatload of money. What good does it do you to say, hey man, we did $500,000 last year? Well, you did good. How much you pay in taxes? $225. You think that's good? I don't. And you're going to see why in a little bit. All right. So, house, fair market value, $150,000. All right. You place it under contract for $90,000. You do $10,000 worth of rehab. All right. You just added $50,000 worth of net worth to your portfolio. If you sold the property in 6 months for $150,000, you realize $50K at closing. All right. Considering your agent's commission. If you use an agent to sell the property, now what does that look like? You had a $50,000 gain because that's how much money you made. Because you sold the property in less than a year, then that's short-term capital gain. So let me tell you like this. If you hold the property better than 365 days, 1 year and 1 day, okay, then that's long-term capital gains. Long-term capital gains, depending on your tax rate, is 15% or 20%. If you sell it in less than that, then you pay your tax rate plus self-employment tax. All right. So you see what's going on in this situation. So what you got right now, all right, you sold the property in 6 months, you're in a 22% tax bracket, you're going to pay $11,000 on your gain to the federal tax, and then you're going to pay $7,650 in self-employment tax. So out of that $50,000 you made, you actually realized $31,350. Now, somebody out there should have threw something at their TV right now, but don't break it yet because you still need to be listening to what I'm trying to tell you. All right. Next situation. Same thing. You got the property, $150,000 fair market value. You place it under contract for $90,000. You do $10,000 worth of rehab, which added $50,000 to your net worth. Now you decide that you're going to hold this property. You put it on your board for a little while. So basically, you put this property on your board, that monopoly board. You put it on there and decided you would hold it for a little while. So now you sell it to somebody on a lease with an option to buy over a 12-month period. All right. So now they buy it. Guess what happens? Because you sold it for sale by owner, there's no agent commission involved. So you save taxes on that. Your $50,000 gain that you're making now is considered long-term capital gain, taxed at 15%. So you pay $7,500 on the gain. And guess what? Because it was a long-term hold investment, you don't pay any self-employment tax on that. So now $50,000, you get $43,000 versus $34,000, whatever the other slide was. So you see what I'm saying? You got $43,000 in that situation versus $31,000 in the other situation. So you decide where you want to be. This is how you make a plan so that you can understand where you're at in the game so that you can do the things that you can do, guys, to be profitable, to actually be profitable. Okay, next thing right here, limited liability company. Let's talk about those, LLCs. They have the liability protection of a C corporation. LLCs are easy to set up. Most of you or some of you set some up yourself already. That therein lies a problem in most cases. Because most of us guys, we don't know what the heck we're doing. We go to the Secretary of State's website, download the little articles, organizations, forms, fill them out, send the stuff back in, or fill it out online. And within a week or so, we have our company, right? And you get your little company stuff. You got your file folder. You just as happy as a pig in mud. You ain't looked at nothing. You took and put your paperwork inside your file folder and sit it in a cabinet and never look at it again. Now you have a problem. And some attorneys asking you for all this information and data that you never did, that you never completed, that you never filled out. So now guess what? They pierce your corporate veil, meaning that when they say pierce the corporate veil, that means they blow through your entity as if it's not there. And there you are standing there, naked, with no protection. So you have to make sure, guys, that you actually put these documents together and put them together in order and do the things that you need to do to make sure you keep your entity sustainable and viable. So going back to LLC is easy to complete. You have what's called a Form 1065 for a tax return, which generates a Schedule K-1. We're going to talk about that. I'm going to show you the benefit. Tax rate is your personal rate. Profit and loss goes to the 1040. All right, because an LLC is a flow-through entity, guys. It flows through to the members. All right, it's good for keeping properties. It may not be as good for flipping properties. We're going to talk about that later. You form it with articles of organization. All right, you file for an employee identification number using the Form SS4. All right, to get your tax ID number so that that's a separate entity from you. Again, remember what we said earlier. You got your Social Security number and you have your employee identification number. Two distinct individuals or two distinct entities. All right, the partners can be your spouse, or a friend in your LLC. All right, now if you set up an LLC and you decide that it's just going to be you, then it will be treated for tax purposes as a disregarded entity, meaning you're right back to being a sole proprietor for the most part again. Like I said earlier, you don't want to be there. If you have two or more members in your LLC, the default is that you actually default to what's called a partnership, an LLC partnership. So that's the limited liability company. You default to an LLC partnership. So when you have an LLC, LLC is a separate legal entity. And like I said earlier, it can be taxed as a partnership, all right, which brings about more favorable tax benefits and lower audit risk. Remember, if you're a sole proprietor, then you're more susceptible to audit. All right, with an LLC partnership, you have the flexibility of allocating income and losses to the members in a manner that best suits the members' tax needs. So you guys can sit down and talk about who needs what, and you can set it up in your operating agreement as to how much of money they get or not get, how much of the losses they may need and actually they get versus what you get. So it's some good things that you can do by being an LLC. All right, so with a single member LLC, like I said again, sole proprietor. You file your taxes on Schedule C or E, all right? Or as a corporation on IRS Form 1120 if you decide that you want to be a C corporation. Again, guys, you don't want to be a single member LLC. I'm going to tell you, you do not want to be a single member LLC. A lot of attorneys will put you right there real quick, but that's not where you want to be. It's not favorable for you from a tax perspective, and in some cases, not favorable for you from a liability and asset protection perspective. With two or more members in the LLC, you form a partnership, which generates a separate tax return. I want y'all to understand this because here we go. So when you form an LLC as a partnership, guys, then you generate a separate tax return for your business. Listen to what I'm saying. A separate tax return for your business. So you have your personal return and then you have your business return. Remember that LLC, if it had two members, then this is how the income and the would flow. If you had 50% membership each, then basically the money goes in at the top and that generates what's called a form or Schedule K-1 that goes to each member, and each member reports that income or loss on their respective tax return. Everybody follow me? We good? I want to make sure y'all good on that. The money flows through the company down to each member in proportion to their interest, which goes over to their tax return. Again, that's called a Form 1065, U.S. Return of Partnership Income, okay? Now, and this is what it looks like. So there goes your Form 1065. One individual is going to get his profit and loss report. The other partner gets their profit and loss report. And then what we're going to do, we're going to take our respective K-1, and then it goes over to our Form 1040. All right. So now the income that you got from your LLC is going to go over to your personal tax return on what they call Schedule E, all right, which is right here. So that's where your income is reported on Schedule E, all right, in Part 3. And we'll talk about that too shortly. All right, so that's how your stuff is going to be set up. So you're going to have your personal return, and you'll got your business return. Everybody with me? I want y'all to put me on today. I want y'all to see. You got your personal return. Listen to me closely, guys, because you need to see this. You have your personal return, and you got your business return. All right? Now, what's going on? You got two different tax returns. You got one respective to your business, one respective to you personal. What's going to happen is one return is going to flow. One return, your personal return, is going to go to one department or branch of the IRS. The other return is going to go to another branch of the IRS. So it went to two different places. I want y'all to see me when I say this again. Two different places, right? I want y'all to see me. Personal return went to one branch. Matter of fact, personal return, depending on where you filed in your state, the personal return went to Kansas City. The business return went to Utah. Now, put me on full stream. Put me on there, Dave. Let's see. Personal return went to Utah or Kansas City. Business return went to Utah. So the return went to two different places. Let the IRS figure out how we're going to marry them up and check everything out. This department has one, this branch has the other. Not saying you're trying to do anything frivolous, but where would you want to be? You got two separate tax returns. When you file as a single member LLC, you got one return with everything in the one return. So you just gave everybody point blank everything they need to deal with you. Okay, in one nice little pile. Where in the other case, one return went over here, one return went over there, and let the IRS figure out how they're going to marry it all up and start checking stuff out. Okay? That was worth your price right there. And so I'm going to tell you, if you have a CPA that tells you, I don't know no reason, you don't really do a lot of business, I don't necessarily think that you actually need to do all that, because the only thing you're doing, you're just creating another tax return, which, I'm going to charge you another $300 for that. As soon as they say that, shake their hands and say, thank you for your business. Okay? Thank you for your time. You just ain't the one. Okay? Tell them you ain't the one. You just ain't the one. All right? So because what they just did is they put you in that pile. They put you in that pile over there with the guy that's doing all the frivolous business activities, the person that's got a cake, that makes cakes, and the person that's doing a landscaping and lawnmower business. All right? They put you in the same pile, so now you got a better chance of being audited. All right? So that's your limited liability company. All right, the other part, in the liability company, guys, you can get, you bypass passive activity loss limitations. This is a biggie. Passive activity loss limitations is a biggie. And I'm going to pause for effect right there. Passive activity loss limitations, I want you guys to understand this stuff. So I want to do something a little bit different, a little bit unconventional. We're going to take 5 minutes. So run to the bathroom, do whatever you got to do, get right back here in 5 minutes, and then, and you might want to grab your snack or so, because I'm going to have you look at something that's going to take a minute, but you're going to be blessed by it. All right? So go ahead and take your 5-minute break, be back here so we can continue on, because I want to talk to you about these passive activity loss rules. Let's just say before you go, passive activity loss rules, guys, were made because the government figured out that individuals were going into businesses, let's say real estate, for instance. So people of affluence would go out and buy properties all over the United States. All right? And they would buy properties and make no attempt whatsoever to do anything with them. No attempt whatsoever. So basically, they buy property in Florida, buy some properties in Los Angeles, buy properties in Las Vegas, New York, or whatever. And properties may just sit vacant. And then come tax time, they start doing write-offs, massive write-offs to expense all this stuff. So the government came up with some rulings and said, nah, you got to actually actively be in business with that. You can't just be out here making a boatload of money or not paying taxes and you're not actually doing anything with the properties. You just got them. So they came up with these passive activity loss rules. And so passive activity loss rules means, guys, that if it's not an active business, okay, active business, wholesaling is an active business. But if you're a landlord, that's a passive activity. IRS considers it almost being like a hobby. You might have 65 or 70 houses, but it's still a passive activity. So you have to make sure that you're set up properly so that they don't limit your losses. Because basically, guys, the way it works, based on your income level, your losses in a passive activity are limited to $25,000 a year. So that means if you have losses showing on your balance sheet, then you're only limited to $25,000 in write-offs. So if you had $100,000 worth of write-offs, you're limited to 25, and you have to roll over 75. And you might be rolling them over like that till Jesus comes. But the bottom line is, at some point in time, when you sell something, you can recover some of that stuff. But you want the benefit of those losses every year that you have them. So you don't want to be a passive activity individual. All right? So you want to know what you need to do to be what we call a real estate professional. And so a real estate professional can write off any and all losses regardless of the amount of the losses. Meaning this, if you and let's just say you're working spouses. No, you have a working spouse and you're doing real estate as a business. Your working spouse makes $100,000 a year and they pay, say, $24,000 or $30,000 in taxes on their $100,000, right? You're working your real estate business and you have losses in your real estate business. Put it fully on me, Dave. You have losses in your real estate business. What that looks like, guys, is this. Your spouse had a $30,000 tax bite. You got losses in your real estate business. Your losses in your real estate business can roll over to your spouse's tax consequences, which means this. I want y'all to listen. Listen to me closely. If you were limited to $25,000, you couldn't do jack. But if you're a real estate professional, you can write off all the losses. That means you can take a full deduction of all of your losses, which means if your wife had a $30,000 tax consequence, meaning that's the amount of money she was going to have to pay on the money she made. Because of your real estate business, you just wiped it all out, and now you got a $30,000 tax return. All the money came back to you. Keep looking at me, because I know you. If you know, I'm just letting you know what you don't know. Because I'm gonna tell you, yours truly. When I figured this stuff out back in about 2002, guys. Once you look, and we're gonna take that break. I think I was crazy back then. I was just a control freak, and so I'm doing my taxes. I'm sitting there doing my taxes and sold a whole bunch of houses. So probably we sold about $300-some thousand worth of houses, had another $400-some thousand, 230-some thousand, whatever, in salaries and whatever. And we had also made all this money. And you guys that ever did your taxes and you used TurboTax or tax cut or whatever, sitting there doing my taxes, guys, I'm sitting there punching all the numbers in, looking up on that right-hand screen, it said that I owed, all right, like close to $80,000 in taxes, sitting up in the right-hand screen. And y'all see me sweating now. I was sweating harder than this then. So I'm sitting there figuring out, doing my taxes, and then I started putting my properties in there. Everything that I had on my board, I started putting them in there. And all that depreciation and all that stuff went in there. And by the time all was said and done, I got like a $12,000 return from the IRS and $6,000 something from state. Did y'all hear what I just said? Made all that money, got a $12,000 return from the IRS, $6,000 something from the state. When I said, man, this can't be right. So I sit there and I hit that audit button. I hit that audit button, and the thing did, it went through all the little audit process, came back up clear, green lights, all that good stuff. And I still had $12,000 from federal, $6,000 from state. Guys, I had to sit there and look at that. I sit there and looked at that computer a few minutes. I sat there and looked at it, and I started getting nervous. I got up and went back out to the window, pulled back the blinds. I want to look out there and see if somebody was looking for me. So what I'm trying to tell you is you don't know what you don't know. Take your 5-minute break. We'll be back here, and send me my darn offering. I want my offering.